Whether you're new to the world of investing or looking to brush up on the basics, you're in the right place. Today, we'll cover everything you need to know to start growing your wealth with confidence. Understanding the basics of investing. First things first, let's define what investing actually means. Investing is the process of putting your money into assets with the expectation of generating income or profit over time. These assets can include stocks, bonds, real estate, mutual funds, and more. The goal of investing is to grow your wealth and achieve your financial goals, whether that's buying a house, funding your child's education, or retiring comfortably. Before we dive into the different types of investments, it's important to understand two key concepts: risk and return. Risk refers to the possibility of losing some or all of your investment, while return is the profit or income generated from your investment. Generally, higher risk investments have the potential for higher returns, while lower risk investments offer more modest returns. Types of investments. Let's explore the various types of investments available to you. Stocks. When you buy a stock, you're purchasing a small piece of ownership in a company. Stocks have the potential for high returns, but they also come with higher risk. The value of a stock can fluctuate based on the company's performance and market conditions. Bonds. Bonds are essentially loans that you give to a company or government in exchange for regular interest payments. They are generally considered lower risk than stocks and provide more stable returns. However, the returns are typically lower as well. Mutual funds. A mutual fund pools money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. This allows you to invest in a variety of assets without having to pick individual stocks or bonds. Mutual funds are managed by professional fund managers who make investment decisions on behalf of the investors. Exchange-traded funds, ETFs. Similar to mutual funds, ETFs are investment funds that hold a collection of assets. However, ETFs are traded on stock exchanges like individual stocks, making them more flexible and accessible to investors. Real estate. Investing in real estate involves purchasing property with the expectation of generating rental income or capital appreciation. Real estate can be a stable and tangible investment, but it requires significant capital and management. Certificates of deposit, CDs. CDs are time deposits offered by banks with a fixed interest rate and maturity date. They are low-risk investments that provide a guaranteed return, but the returns are typically lower compared to other investment options. Commodities. Commodities include physical goods like gold, silver, oil, and agricultural products. Investing in commodities can be a way to diversify your portfolio and hedge against inflation, but they can be volatile and influenced by global events. Now that you understand the different types of investments, let's talk about diversification. Diversification is the practice of spreading your investments across different asset classes to reduce risk. By diversifying your portfolio, you can protect yourself from significant losses if one investment performs poorly. Assessing your risk tolerance. Before you start investing, it's crucial to assess your risk tolerance. Risk tolerance is your ability and willingness to endure market fluctuations and potential losses. It varies from person to person based on factors like age, financial goals, and personal comfort with risk. To determine your risk tolerance, ask yourself the following questions. How long do you plan to invest? What is your investment goal? How much loss can you tolerate in the short term? Do you have other sources of income or savings to fall back on? Your answers to these questions will help you decide how much risk you're comfortable taking on and guide your investment decisions. Once you have a clear understanding of your risk tolerance, you can start building your investment portfolio. Here are some key steps to get started. Set clear financial goals. Determine what you want to achieve with your investments. This could be saving for retirement, buying a home, or funding your child's education. Having clear goals will help you stay focused and motivated. Create a budget. Before you invest, make sure you have a solid budget in place. Ensure that you have enough money to cover your living expenses and an emergency fund before investing. Choose the right investment accounts. There are various investment accounts to choose from, including individual brokerage accounts, retirement accounts like IRAs and 401(k)s, and education savings accounts like 529 plans. Each account type has different tax advantages and rules, so choose the ones that best suit your goals. Start with low-cost investments. For beginners, low-cost index funds or ETFs can be a great starting point. These funds offer diversification and have lower fees compared to actively managed funds. Automate your investments. Set up automatic contributions to your investment accounts to ensure consistency. This takes the guesswork out of investing and helps you stay on track with your goals. Monitor and rebalance your portfolio. Regularly review your investment portfolio to ensure it aligns with your goals and risk tolerance. Rebalancing involves adjusting your portfolio by buying or selling assets to maintain your desired asset allocation. Common investment strategies. Let's discuss some common investment strategies that can help you grow your wealth. Dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. Dollar cost averaging can help reduce the impact of market volatility and lower the average cost of your investments over time. Buy and hold. The buy and hold strategy involves purchasing investments and holding onto them for an extended period, regardless of market fluctuations. This strategy relies on the belief that markets tend to rise over the long term, and staying invested allows you to benefit from this growth. Value investing. Value investors look for undervalued stocks that they believe are trading below their intrinsic value. The goal is to buy these stocks at a discount and hold them until their price rises to reflect their true value. Growth investing. Growth investors focus on companies with strong growth potential. These companies may not be profitable yet, but they have the potential to grow rapidly and generate significant returns. Income investing. Income investors prioritize investments that generate regular income, such as dividend-paying stocks, bonds, and real estate. This strategy is ideal for those looking for a steady stream of income. Investing can seem overwhelming at first, but there are plenty of resources available to help you learn. Here are some recommended books and websites for beginner investors. Books. The Intelligent Investor by Benjamin Graham. A Random Walk Down Wall Street by Burton G. Malkiel. Rich Dad Poor Dad by Robert T. Kiyosaki. The Little Book of Common Sense Investing by John C. Bogle. Websites. Investopedia. www.investopedia.com. The Motley Fool. www.fool.com. These resources provide valuable information on investing principles, strategies, and market analysis. Avoiding common investing mistakes. Even the most seasoned investors make mistakes. Here are some common investing pitfalls to avoid. Timing the market. Trying to time the market by buying low and selling high can be risky and often leads to poor results. Instead, focus on a long-term investment strategy and stick to your plan. Chasing performance. Investing in the latest hot stock or fund based on past performance can be tempting, but it doesn't guarantee future returns. Instead, focus on a diversified portfolio that aligns with your risk tolerance and goals. Overreacting to market volatility. Market fluctuations are normal, and reacting emotionally to short-term movements can lead to poor investment decisions. Stay calm and stick to your long-term strategy. Ignoring fees. High fees can eat into your investment returns over time. Be mindful of the fees associated with your investments and choose low-cost options whenever possible. Lack of diversification. Putting all your money into one investment or asset class can be risky. Diversify your portfolio to spread risk and increase the potential for returns. Investing is a powerful tool for building wealth and achieving your financial goals. By understanding the basics, assessing your risk tolerance, diversifying your portfolio, and avoiding common mistakes, you can grow your wealth with confidence. Remember, investing is a journey, and it's important to stay informed and adapt your strategy as needed.